Welcome everybody to attend our awesome event, Finance Hacking 101, hosted by Entreflow Consulting. My name is Enoch, and I'm on the Vancouver Startup Week team. First, I'd like to take a moment just to acknowledge that we're grateful to be virtually gathered on Indigenous land. So regardless of where you're joining us from, we are grateful to be on the traditional, ancestral, and unceded territory of the Musqueam, Tsleil-Waututh, and Squamish peoples. I'm privileged to live, work, and play on these lands. And so once again, welcome to Vancouver Startup Week 2021 and to the Finance Hacking 101 event hosted by Entreflow Consulting. This session is part of the VSW Growth Track and is proudly supported by Innovate BC. Innovate BC is a Crown agency that provides small businesses around the province with funding, business coaching, and educational content. They're helping entrepreneurs and founders start and scale their businesses and adapt to the changes brought on by COVID-19. So if you're looking for support for your business, make sure you stop by their booth to learn more about how they can help. And if you have any questions for our speakers, as mentioned, please post them in a Q&A in the Whova session. So you can also upload these questions and I'll be keeping an eye on them. So I'm gonna pass the mic over to you, Helena, to kick us off.
Great, thank you so much and welcome everyone. Delighted to be here with you today. I'm very excited that we're able to have the Vancouver Startup Week given that we're in a virtual environment and coping with COVID. So welcome everybody. A little bit about myself to start off. My name is Helina Patience. I'm a CPA CMA based in Vancouver, and I'm the CEO of Entreflow Consulting Group, which is a licensed CPA firm, also does a lot of HR work and software implementations. We've been working with startups for almost 6 years now to really help them get up and running and make really good decisions and not make mistakes as they grow. And so today's Finance Hacking 101 is really to arm you with some tips and tricks on what to not do and things to consider so that you can have a smooth sailing with your startup. And as well, some other things to consider as you grow. So super delighted to be here today. Thank you to everyone who made this possible. And feel free to reach out to me at any time afterwards as well if there's any burning questions or other things you want to talk about. I like to talk about business nerdy things. So like I mentioned a little bit about Entreflow, we really are focused on accounting, finance, HR, and systems. So we're really here to help small businesses grow. We work with a lot of high growth companies, especially as you can see here, startups, scale-ups, technology, and manufacturing companies are kind of our sweet spots that we like to play. We're cloud-based, so we're all about technology. We call ourselves lazy accountants because if there's a way that we can automate something, we will do that. So if you're looking to for some technology to help run your firm, your company better, always happy to nerd it out on tech because that's what we do on a regular basis here, and finding ways to make things more efficient and effective so you can spend more time on the higher value things in your organization, growing your business and not on the mundane. So we're going to start off with 7 common finance mistakes. Now, I know in the description we had 5, but there's actually 2 other ones that we decided to add into the mix here. So you get an extra 2 bonus ones. These are ones that we've seen over the years a lot. And so they are really, really, truly quite common, and they really trip people up a lot. And so we've working in an accounting firm, we find people in interesting situations where they've made some of these mistakes for many years, and then have had to deal with the hard work of getting it rectified. So don't make these mistakes. These are really there. We're sharing these with you to help you to make sure that you're set on the right footing here, depending on where you're at in your business stage. So first and foremost, and I'm of course a little bit biased because I'm an accountant, but not having proper accounting software in place is really, really challenging, and it creates a lot of issues for companies right out of the gate. There's some amazing software out there, really inexpensive software for businesses nowadays to manage their accounting software. So, and I'm going to talk to you a little bit about those as we go. So really no reason not to get set up properly with your accounting function out of the gate. As soon as you have transactions, it's time to have some software in place. Doing it after the fact is always more more costly than doing it real time as you go. Okay, so a couple of things to consider. Some problems that it causes when you don't have your proper accounting software in place is it's really hard for you to track your business results. You don't want to be tracking how your business is doing by your bank balance. You want to track it by the results of all the transactions. If you don't have accounting in place, software in place, you won't be reviewing your results on a regular basis, which for some companies, it might not seem like a big deal if you're just starting off, but really quickly as you grow, it goes from being not a problem to a big problem really, really quickly. It's really time consuming to do it regularly if you're doing it like say in Excel or not doing it and then having to do a whole bunch of catch up. And it's also easy to make mistakes and errors in any of the reporting that you're pulling together when you're doing it manually. So, out of the gate, just get some software in place. Here's some examples. Xero and QuickBooks Online are two accounting suites that we use on a regular basis at Entreflow. They're fabulous. They're easy to learn, easy to get set up on, and start using on a regular basis. There's a lot of people that are familiar with these programs too. So if you don't want to do the bookkeeping yourself, there's a lot of people that can support you, such as Entreflow and others. And then on top of that, there's a lot of applications that integrate directly with QuickBooks and Xero, which means that you can have really good workflows within your business to move data from one place to another. So for instance, if you are sending out, say, proposals, you can have those proposals pushed directly into your accounting software as invoices. You can have your payments going from your accounting software directly from your bank out to your vendors automatically, or with some approval steps, obviously. But there's lots of great workflows that you can have in place to ease the administrative work within your organization. At the end of the day, the more regularly you're doing your bookkeeping, the better the quality, the less you're going to pay for in the long run, because there'll be fewer errors and you'll have all the, the memory of what those things were at the time fresh in your brain. Here's a screenshot of what QuickBooks Online looks like. It's a beautiful program, easy to use. You don't have to be an accountant to figure it out. It does help to get some grounding in what accounting is all about and how to do the bookkeeping, obviously. But it's a super easy program to use. And then here's a little screenshot of what Xero looks like. Again, really nice UI. What's nice about these two programs is that it integrates with your bank. So it'll bring in those transactions directly from your bank account so that you can then categorize them correctly. And there's other software that you can use to basically get those, the backup for those transactions. So the receipts or the bills, for instance, and get those pushed into the software too. So it makes it really easy to manage the day-to-day data. Okay, on to the second one, poor pricing strategy. And this is a really common one that we see. So people have these really great ideas about what they want to do, and they want to make it cost effective because then they'll think they got more people that will be interested in what they're doing. And they set a price point that doesn't make sense for the amount of effort or the costs involved in actually delivering that product or service, whatever it might be. Some of the problems that it causes, obviously the business earns less income than it should or that it could. The business fails to succeed. Unfortunately, this is like a really common reason why businesses fail. The volume that they need to achieve in order to make a decent profit at that low price point is just too high. And it becomes a huge marketing problem. And then also brand erosion. So if it's, you're giving it away, or it appears like you're giving it away, there's the implicit value isn't there for consumers. So a lot of challenges, and it's really easy to get caught up in having in this idea of having a cost-effective solution for people, but it can work against you quite a lot. So some things to think about, you really want to consider your pricing strategy. So what are you offering, and what is, the next best option for your customers? And if the next best option is, $100 product, well, you don't want to be offering a $5 product. You want to be offering something that's, slightly close to the other options, so that, because that market exists and that's what people are willing to pay anyhow. You want to do your research and check back on that research periodically, because the market changes. You'd be surprised at how quickly other competitors can pop up or can pivot, especially this last year. It's been a year of pivoting for a lot of people. So make sure that you've done your research and you know what your competitors are up to and how they're positioned, what they're offering, what the price point is, what the value is, so that you, well, first of all, can be able to, deal with any pushback from potential customers, but also so that you can keep competitive. Don't base your pricing on too few data points. So a lot of times people say, well, I was talking to my aunt and she thought that blah, 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 or, I talked to a couple of people and then they raised this one point. And so now we're changing. No. You need to have a big data size set to make this decision. So, if you're going to base it on anecdotal information, you want to interview a number of people, not just Aunt Bertha and your mom. You want to get 100 data points, send out a survey of some kind, do some A/B testing on your website to see how do people interact with what you're offering, and how much time do they spend on the site, or what kind of call to actions they might jump into, depending on the price point. And it's interesting. We've done some work at Entreflow with some of our clients where we were testing out some pricing, and it's not always the lowest price option that we put out there in our A/B testing that people go for. Ironically, you think it would be, but it's not. So you'd be surprised how the market will react to pricing. So it's really good to test that out and do your research. A couple of dimensions on pricing to consider as well. There's kind of 4 dimensions, as you can see from the quadrants here. So the first one is your cost plus. So that's looking at like for instance, with construction, where you take the total amount of cost that's incurred for whatever that is. So in the case of construction, all the costs, the labor, the materials, and what have you, any rentals, and then you add a margin on top of that. So you might say, okay, well, our pricing is basically 20% above our cost, or 50% above our cost, or what have you, and that's your pricing. So basically, very little wiggle room there, depending on what the market is charging, or is charging for materials, and the labor market is expecting from a labor perspective, you're just going to get a margin on top of that. Okay, and that's pretty straightforward. The next one is competitive pricing. When you look at clothing manufacturing as an example, for instance, competitive pricing is looking at basically what are the alternatives essentially, and compared to the other competitors in that market. So, what is the typical cost for a t-shirt, for instance? And then if you look at the economic value to customer, which is the rational type of pricing strategy, it's looking at something like for example here, the business software and the time saving it'll bring. So rational pricing is looking at, okay, like I mentioned, the next best option idea. Okay, well, if I were to do this manually, it would cost me this and take up this much time. Economic value to customer pricing strategy is looking at, okay, this option that we have over here is now going to save them this amount of time and this amount of cost. So here's a good price point that they'll be able to reasonably say yes to because of the time and cost savings. From a rational thinking perspective. And then the fourth one is the customer willingness to pay. And this is the irrational thinking. So this is more on the brand value kind of pricing stream. So looking at something like a Banana Republic shirt versus a Costco shirt. If the pricing for Banana Republic is based on this perceived value and the willingness of those customers to pay. So, people will pay for a logo, that there's a implicit value to that, even though that t-shirt might have been made at the same factory as that Costco equivalent, same quality, same threads, yada, yada. One has a logo on it and it's in a Banana Republic shop. The other one is sitting in a Costco shop. And very, very different price points, but people are willing to pay more for that Banana Republic one because it came from Banana Republic and it's got the logo on it. So that's the irrational pricing. Now, all these 4 are totally legitimate, and it totally depends on what your product and service is. But there's different dimensions that you can consider for your own pricing strategy. And another thing to consider when it comes to your pricing and what you're offering to the world, you can offer quality, you can offer some sort of time savings, and you can also offer price, cost effectiveness. Essentially, in order to have a successful business, you can't offer all 3 of those at the same time. So whatever you're offering, it can't be high quality, fast time, low price. It doesn't work. So you basically choose 2 of those things, and you can focus on those 2 things, and that's what your value is out in the marketplace. But you can't have all 3 because you won't be able to run a successful business with those 3. It's not possible. All right. Item number 3 is your inflexible fixed expenses. Okay, so this is another common mistake that people make. They get really excited about starting their business and they go get some office space and they're locked into a 5-year lease, or they buy vehicles rather than, say, leasing them or even renting them for a little bit first and see what happens. So getting stuck in long-term leases and contracts makes it really hard for you to pivot if there's something that you missed with your business model or your business plan that is going to make be at a detriment to your business success. So, it reduces the flexibility and agility in pivoting the business model if you've got, really solid, high fixed expenses that you can't change. And it also puts financial strain on the business unnecessarily as you grow. So some solutions to this: you want to budget and plan out your spending. So you want to make sure that you've got a solid budget in place and you're looking at some of these fixed expenses and taking a hard look at whether or not they're actually needed. Now, interestingly, over the last year, a lot of businesses have taken a look at these fixed expenses and, reevaluated if they're really needed or not. So you see a lot of people have given up their offices, have their office space. They've reduced their extra expenses related to their offices. They figured out how to use technology rather than printing paper and having printers and all that sort of business everywhere. So they're finding ways to reduce their fixed expense, but it's something you need to think about when you're starting your business, to make sure that you're being very careful about those things you're getting locked into, especially for the longer term leases. You want to test out your idea before locking yourself into a lease. It might be that you find this great location for your retail space, and it looks great and the price is great, but you haven't done your research. You don't, and perhaps there's already like enough, too many of your competitors on that same street, or there's no interest for your type of business in that area. And I've seen this happen with some clients before. So you want to make sure you really understand the neighborhood and what's going on in that neighborhood. And it might be better to, say, sublease in the neighborhood first, test it out and see what happens, and then from there decide if you want to stick around. You want to bootstrap where possible. Order fewer quantities for your first run than rather than taking higher volume discounts. So this is especially true for, say, manufacturing companies. So rather than locking yourself into a high volume count for your first orders, yes, you'll get it at a better discount, but you might get the product and realize that it's not right. Maybe there was a design flaw. Maybe that vendor isn't actually that great at manufacturing. That can happen. So, it's better to order some fewer quantities first, test it out, make sure it's going to work, make sure that the consumers are interested in it, and then consider higher quantities. And then hire carefully. So one of the most expensive fixed costs is employees, right? So make sure you're very, very careful and intentional with all of your employees. Don't hire cheap. You don't want to get, super cheap employees that aren't able to actually do the work and help you out with things. And you spend all this time mentoring them instead of actually growing your business. That's a common mistake that a lot of business owners make because they've got tight budgets. So, consider how you can maybe get a contractor part-time or a part-time employee that's going to be able to make more of an impact out of the gate first, and then see how you go from there. So a couple considerations on your fixed expenses. The next one is, getting offside with the CRA. This is never going to serve you well. So, common mistakes people make is they don't set the cash aside for the taxes. They're late on their filings. If the CRA calls, they're in poor communication. Never a great thing, and certainly as an accountant, not a great thing that I like to hear. Or calls from the CRA are never fun. Now, when you're offside with the CRA, this causes a lot of problems for you personally, because as a business owner, you're personally responsible for any debt with the CRA. But also it makes it really hard for your business to grow, right? If you have any debt outstanding with the CRA, it's really hard for you to raise debt or investments. You're also paying unnecessary interest and fines, and so that's obviously affecting your cash flow unnecessarily. I have had clients who came to me and it's just coming to us as a client, and the CRA had frozen their bank accounts. a great first impression, that's for sure. So they can do that. They can freeze your bank accounts, and that's a really awful situation to be in. You basically are at that point where you need to negotiate with them to get a payment plan in place and start that payment plan before they'll do anything to lift the freeze. And sometimes they won't until the whole debt is paid off. So when you do not communicate with them, that's where they will go to, is the bank freezing. And at the end of the day, this is all going to put your personal credit at risk, which you do not want to do. So, you know, these are some pretty extreme things, but essentially it's pretty simple with the CRA. You know, make sure that, you know, your accountant has access to the represent a client, which is the third-party access that you can give somebody to your CRA account, so they can actually see what's been filed, because sometimes there's some honest mistakes that happen. You know, maybe something's filed and it was entered incorrectly on the CRA's end, and they'll be able to go in and actually to rectify that. Make sure that all of your sales taxes are set up correctly. You know, a common question, you know, you don't need to charge GST until you've hit 30,000 in revenue for that year for most cases. But if you've gone over that $30,000 in revenue threshold, then you do need to remit for the whole year. So a lot of businesses just get their GST filing set up right out of the gate. And then you're good to go. And also you're able to take advantage of those input tax credits. With the provincial sales taxes, a lot of times there's no threshold. So as soon as you start selling, you have to start collecting and remitting the sales tax. So make sure you're clear about what needs to happen from a sales tax perspective. Know your remittance schedules and make sure you file on time and pay on time. And you usually have to leave a couple of days grace period from when you file and pay for some of the PST authorities. So just make sure you're on top of that. Set your sales and payroll remittance money aside so that you don't spend it. A lot of businesses will collect the GST and then it's in their main bank account, and then they spend it. And then, you know, if they're annual filers, come to the end of the year, they've got this big GST bill that they have to pay, and it's a big surprise. So if you are collecting GST and other sales taxes on a regular basis, stick it into a savings account if you're not remitting it right away, and then you can't touch it. You know, I recommend setting 15% of your monthly net income aside from corporate taxes, again, so that you don't have a big surprise at the end of the year there too. You know, paying corporate tax is actually a good sign. It means you're making money, but you don't want the surprise of the cash flow surprise later on. Get your taxes done right away. You know, last year was a little bit of an interesting year. We had a lot of leeway on the timing. Unfortunately, we're not getting any leeway this year. So make sure your taxes are done on time, so you don't get those fines. And if you do get a letter from the CRA or a phone call, just get on the phone with them right away. They're usually very willing to work out a payment plan if you've been unable to remit for whatever reason, or something's come up or happened. They're usually very willing to work with you. They do not deal well with radio silence, and that's when they have to move into more extreme measures, like sending you onto their collections department, which is not fun to deal with, and then also the bank freezing. So just keep them in a communicative manner and all things will be okay. Number 5, poor budgeting and forecasting. So a little joke for you, a little brain break joke. I love this, it cracks me up every time. So you've got the little budget and a little arrow to the side. Now that's the kind of out of the box thinking I've been talking about. That's your extreme budgeting. Okay, so poor or no budgeting and forecasting. So here's some problems this causes. You have no goals for the year, financial goals for the year. And especially if you have a business partner or a team, it's really hard for everyone to be on the same page and be aligned and enrolled in what's supposed to happen this year if it's not actually written down. So that can cause some issues with everyone striving towards the same unified vision and working towards that. There's no sense of the break even. So at what point is your revenue enough to cover all of your expenses? You have no way of knowing if you're on track or not for the year, and it's hard to make decisions, especially if you have something like a pandemic show up. You know, how do you know if one decision or the other is actually going to make a positive impact on your business if you don't have any baseline to look at? Also, if you're raising or trying to get some debt, everybody's going to want to look at your forecast. So where are you anticipating that you're going to be in profit, and how much? How long is it going to, do you have the ability to pay off the debt, you know, especially if you're raising debt? So they want to be able to see that you've done some thinking. It's also a great way to test out if your business makes sense. You know, so put all your assumptions in there and you can see, at what stage this is actually going to make sense? Is it going to take me 5 years to make a profit? Well, can you live on beans and toast for 5 years? That's up to you to decide. But it's good to be able to see the eventuality before you get there. So the solution, very simple: set a budget. And set it annually at minimum. If you're newer, this might be, you might be adjusting this as you go throughout the year until you're super clear about what your business is going to be doing. And as you get more traction with the market, adjust if there's any major changes. So this last year has been a year of rebudgeting and forecasting for our clients with all the pivots and business changes. And that's okay. It's just a way to reset, regroup, be clear, and then make some better decisions. It's all good. And then you want to look at those budget to actuals on a monthly basis as well to make sure that you're on track. And so, if it's really off on a month-to-month basis, then that your budget's something needs to be adjusted, or there's some understanding of your business that wasn't there that you need to have. So that is a great grounding thing to do on a monthly basis, to review that. And just to be clear, because a lot of people ask me this question, what is the difference between a budget and forecast? Well, essentially, your budget is an estimate of income and expenditure for a period. You usually set this on an annual basis, and then you're tracking that budget to actuals on a regular basis. And that's kind of like your goal for the year. And it should be tied to your vision, your mission, your big blue sky idea for the year. Your forecast is looking at how you're tracking and you're trending for that year. So it's based on more recent trends, and it's showing you how you're kind of tracking based on the recent past. Usually you're reforecasting, or you're forecasting setting the forecast on a monthly basis. And it's kind of showing you where you're heading. So your budget is where I want to go, and your forecast is where we're heading. Hopefully those things are aligned. Okay, number 6, incorrect marketing spend. This is super common. A lot of business owners don't know how much to spend, where to spend it, what will work, what won't work. A lot of issues with the marketing spend if you don't do this right. So you might spend too little, in which case you might not have as much traction as you need for the year. You might have more effort and cash spent on sales than needed, and your revenue growth, more effort and cash spent on sales. Yeah. And then your revenue growth might be too low and might affect your profit. And if you spend too much, you might be wasting your cash on ineffective campaigns. So your marketing ROI might be off, and your cash reserves are going to be depleted through the process. And then you might have some overcorrection stops with your marketing. So, okay, we're going down this route and it's not working. Okay, let's move over here. And now we're starting from scratch again and going through all the motions there. And then we're going over here. And so just a lot of kind of wasted time, effort, and money from not having a great, clear strategy. And the solution here is that you should have a strategy before you execute. You really want to make sure that you've got clear targeting, so you know exactly who you're going after, what that messaging should look like, and you've got a plan of what you're going to do. You want to always test. I always say with startups, it's kind of like throwing spaghetti at the wall at the start, especially if you're offering something that's new, a new product or a new service. How to market it is untested, right? So you need to kind of throw things at the wall and see what sticks. And you want to be able to do that A/B testing, see what works best, tweak it, adjust it, and figure out what the secret sauce is to actually bring you in some predictable customers. Now, you have to also, if you're not doing the marketing yourself, find the right kind of marketeer internally or marketing agency externally to support you. And 9 times out of 10, external marketing agencies are not good for startups. They don't really work well with startups, because that whole idea of throwing spaghetti at the wall and testing and refining and adjusting and A/B testing and all this sort of stuff is costly for them and not necessarily part of their budgets. So you need to be very, very careful. And same with marketing employees, where they've worked and the type of experiences they have is super important, because if they've never worked in a high growth startup environment with a new product or a new customer base or what have you, it's going to be a huge challenge. It's not like you can, be an expert at a big enterprise company and then come to a startup and be able to just duplicate what you've done there. It's not going to work. You have to have a completely different mindset for the way that you do marketing in a startup environment than from an established company. So make sure that you choose your partners really, really well. And it's really hard for the business owners to actually do this in tandem with growing the business. So you're probably going to need some help to do that. And essentially, once you've tested things out and you've got a, something that has legs and is reliable, well, then you can ramp it up and then you can put the money into it, because then at that point you have an idea of the predictability of your effort, your ROI there. Okay, last one, 7. And this one is my biggest pet peeve, is mixing personal with business finances. Mixing business and personal finances is like eating ice cream with lettuce. And so next time you go and use your personal account card for a business expense, or use your business expense for a personal expense, I want you to imagine lettuce ice cream, because that's what you're creating for your accountant. But lots of issues there. And it also, at the end of the day, it always ends up that it is a loss for the business owner at the end. And I'll tell you why. Okay, so first of all, we've got difficulty in completing the bookkeeping and year-end taxes with ease. You're going to pay more for people to have to do more work to try to reconcile what happened. Business expenses that never perfectly captured, resulting in more taxes being paid unnecessarily. So a lot of times what happens is, the business owner is using their personal accounts. They don't have the receipts, we can't track things down, we can't put it in the books. So you're missing out. You just basically paid for those out of pocket. Not great. Delays in building credit for the company. The banks want to see those transactions going through your business account. They want to see the history there. They don't want to see that it's kind of in and out of personal accounts. It doesn't really help for setting the trust there. And then also it's difficult for investors and lenders to trust the numbers as well. So get a $6 a month bank account out of the gate, and just set that up. And if you're putting any money into the business, transfer it from your personal account into the business account and then spend it out of the business account. It just makes everybody's lives easier. It's so easy to be able to track, okay, you put, $5K into the business. Okay, we got to work that out later. And here's all the expenses for that $5K, rather than tallying up $5K worth of expenses. Here's a whole whack of receipts and then pumping them in there and having to deal with it. It's a lot more time consuming. So the solution, like I said, get a business account set up, use it. Where people usually have trouble is with getting a business credit card. It can sometimes be a little bit more difficult to get one. So a couple of hacks there. You can pre-fund a business one if you want to. So basically you get a business credit card and you put the cash on it and you basically just use that. You can also ask your bank to take a personal credit card and split the credit into 2 cards, and then just use one of them for business only. That's an easy way to get a business credit card as well. And then once you build up the credit with your business, then you should be able to get a credit card. For some industries, it's a lot harder to get a business credit card than others. So for instance, the cannabis industry can be really challenging. It's getting easier, and some of the banks are a lot more willing to give credit than others. So it's just worth asking. Sometimes it's the credit limit that can be the barrier. So if you're just looking for a smaller credit, they'll be able to sort something out. And then once they've seen that you're, trustworthy, then they can increase that credit later on. So there's a couple things to think about, and certainly, avoid using your personal account as much as possible. All right. And a little message from Yoda. This is why you fail. If you do those 7 things, you're going to have some troubles. Don't do it. Okay, and recipe for investor procurement. So for those of you who might be, this is a little tongue-in-cheek break here, but for those of you who are pursuing investment, great. There's 3 ways to basically get, there's 4 ways to get cash into your business. One is revenue, that's the preferred. Next is government funding, then debt, then investment. Okay, and you want to kind of approach them in that order as much as possible. It's better for you in the long run, so you don't dilute your business. However, that's not always the case for all businesses. So for those of you who are looking to get some investors in to help you out, make sure you've got a great MVP complete before you start investing. That makes it a lot easier. They're going to want to see what it is that you've actually got and see that it works and test it out. And be able to see the concept that you're speaking about. You want to see paying customers. The second you've got paying customers, you're a much more valuable business. That you've got a solid team in place and not a hodgepodge of contractors moonlighting, but that you've got an actual dedicated group of people, that you're solving a problem worth solving in a large market. They want to think, they're thinking big potatoes here, right? So it's got to essentially be something that is going to deliver some shareholder value at the end of the day. So you got to be thinking big. Multiple potential for revenue streams. This is absolutely super important for investors. They want to see that you've got some other ways to make cash out of this. And so that if one of the ideas flops, then at least you've got some backups, but also that there's way more of opportunity and potential than just if you had one revenue stream. A demonstrated ability to manage money and forecast. So again, they want to see you've got your proper accounting software in place, you're doing your bookkeeping on a regular basis, your financials are making sense and the numbers look great, and you've got a forecast, so you know where you're heading. So they want to see that maturity from a financial perspective. Having a shoebox with receipts, or here's my Excel spreadsheet with all my transactions in it, just isn't going to cut it for investors. All right, from there, it's really hustle, hustle, hustle. 6 months to a year, it can take a long time to get investors committed and on board. I mean, the investor scene right now is a little bit faster and hotter than normal. So things are happening a little bit faster than you'd expect it to, but that's not always the case. So just make sure that you've got enough cash that you can handle 6 months to a year without an injection. All right. Little side note too, on the accounting software topic, at Entreflow, we offer a 1-week course to help you get set up on QuickBooks Online and also help you with your bookkeeping, to understand how to do your own bookkeeping for yourself, if that's what you want to choose to do. And we can also help you with that going forward too. And we have a special offer for attendees today. And if you go to our website, there's the Entreflow and Vancouver Startup Week page, and there's a place for you to enter a link or your details to get more information about the offer that we have. So the next course is going to be in July, and we'll be doing a 1 week. It's not a full week, it's just in three quick sessions, help you get your accounting software set up and also get you set up to do your bookkeeping. So that's coming up, and maybe we can pop that link into the Whova later. All right, on to some finance lesson. Just checking if there's any questions so far while I take a sip of water.
Yeah, I can help post that link up in a bit, but so far there's no questions yet. Okay, great. Please do ask them along the way. It makes it more interactive for everybody. Happy to answer them. So we're going to talk a little bit about financial goal setting in more detail. The income statement is a common financial statement that we use in accounting that a lot of people don't know a whole lot about. So I'm going to go through that quickly. A bit more on budgeting, cash, and then as well, as I mentioned, love technology. And so I'm going to talk to you a little bit about some applications that can help you get set up for success along the way. Because why do things manually when you don't need to? All right, so financial goal setting. So when you're setting your budget and your goal, you've got a goal for what you want to achieve for the year. You want to think about what you want to get out of the business essentially at the end of the day, because it doesn't make sense to run a business if you're not getting anything out of it, right? And you're able to survive off of it. And you need to know what essentially at the end of the day, what do you need to hit from a sales and marketing perspective in order to actually deliver to you the value at the end of the day as a person or investor in that business. And this whole realm here where the squirrel's hanging out reaching for that lovely little walnut is the bit of the income statement. So let's talk about that. So what is it? It has a couple names. We call it a P&L. We call it a profit and loss, statement of earnings. But it basically shows you how profitable your business is at a given period in time. The equation is basically your revenue. So what you've earned, less your expenses is your net income, also known as your profit. It doesn't show you how much money you have in the bank account. We do accrual accounting in Canada. So basically there are certain types of transactions that we will book in slightly differently based on the timing of them. So we're booking our revenue when it's earned, not when the cash hits our bank account. And we're booking our expenses when they're incurred, not when it's hitting the bank account. So you're going to always have a little bit of a discrepancy between your profit for the month and the cash in your bank. There's obviously a couple of other things that can affect those two things, but that's a common misconception. People say, oh,
well, I had so much profit, but then there's like no cash in my bank. What's going on? It's usually a timing issue, essentially. And you should be running your business on the basis of your net income, and obviously and your cash, but your true test of how successful your business is based on your net income, not the cash in your bank account. So like I mentioned, we use accrual accounting in Canada. Some other financial statements that are common are the balance sheet, which is basically looking at the value of stuff that you own and who owes you money, and then who you owe money, and at the end of the day, the value that it's brought to shareholders. And then finally, your cash flow statement answers the question, where did all the cash go? Here's an example of an income statement. Basically, you've got your sales activities at the top there. So there's your revenue, that's your sales. You also have your cost of goods sold, or your cost of sales for a service company. And those are basically the expenses that are tied to a dollar revenue earned. So easiest way to think about this, if you're thinking from a manufacturing perspective, you have the people on the floor actually producing the widgets or whatever it is. And you have the materials to go into the widgets. Those are the cost of goods sold. The cost of the building that they're in, and the management team, and the benefits plan, and the marketing expense, and the insurance, and all those other things are not tied to that revenue that was earned. So they're in the operating activities. All right, so the revenue minus the cost of goods sold gives you your gross profit. And that's a really important number to know from a target perspective, and to track that so that you can see how you're faring to, say, your competitors. If you're doing some benchmarking, so you can go and see like what other people out in the market are getting from a gross margin perspective, and see how you're tracking to that. Next, you have your operating activities. So, marketing, office, general admin kind of things. Your gross margin less your OPEX is your operating profit. You've got your non-operating activities, interest, income, taxes, all those sorts of things. And at the end of the day, that gives you your net income. Okay, common term that comes up too in this realm is your EBITDA. So especially with investors, they want to know what your EBITDA is. That's basically your earnings before interest, tax, depreciation, amortization. So it's basically take your net income and you add back in those other things. And that basically helps investors and lenders to be able to compare apples to apples when they're looking at comparatives with other businesses. And so it's looking at the non-operating and non-cash stuff, as it were. And why we care, like I said, apples to apples benchmarking and comparison between periods for similar types of companies. Okay. Your valuation on exit may depend on it. So it's something for you to track on a regular basis. And then we have some ratios that we consider too. I mentioned the gross profit. So that's looking at your gross profit divided your revenue. That gives you a sense of like, for every dollar earned, how much is actually left for the remainder of the expenses. Operating margin, then you're looking at what's basically available for the interest, taxes, and yada yada. And then your net income is your net income divided by your revenues. That's showing you at the end of the day, for every dollar of revenue earned, this is the amount that's actually sticking around in the business for reinvestment, dividends, whatever else. Okay, so when you're thinking about your goal setting, you want to think about, what are you trying to get out of the business? Your business profit goal, your gross profit goal, your revenue goal, and that's all ties to your marketing sales goal. So you want to work this way up the channel, and that'll tell you, okay, what do we need to hit from a sales and marketing perspective in order for us to hit that revenue goal, in order for us to hit that gross profit goal, in order for us to hit that business profit goal, or net income goal. And at the end of the day, what I need to survive, or what we want to reinvest in the business, or what our investors need, or blah, blah, blah. That's one way to look at that. And then taking that to the budgeting, now you're going to look at that net income need, and from there, like I said, go back up the step, figure out what you need to hit all of those different expense marks as you go. You can also work from your, so here's an example, sorry. So if you say, okay, I need to have $50,000 in my net income at the end of the year, my operating expenses are 25,000, then my gross margin basically needs to be 75,000. my gross margin is 50%. So for every dollar earned, I have 50 cents in COGS, and basically my revenue that's required is $150,000. Okay. From a sales and marketing perspective, what do I need to do to hit that 150K mark? There's also, a top-down way to look at things as well. So you can look at what are other, what is that big pie in the sky goal that we want to hit? I want to hit 1 million this year. Okay, cool. Start there and work downwards. You can also look at, what is it that, obviously the benchmarking is helpful to get a sense of those ratios. And you can also look at some other KPIs to help you in determining, depending on if you're going top down or bottom up, what is possible. So you got to consider, especially on the marketing side, what's your cost of client acquisition, your CAC, what you want to hit from a recurring revenue perspective. There's a lot of different things that might affect your revenue essentially along the way. And also from a marketing perspective, like what is your conversion rate too? Because you might want to hit $1 million in revenue and you might have a really low conversion rate, and it might not be possible to hit 1 million until you figure out how to get that conversion rate up. All right. I think I covered most of this here already, so I'm just going to go to the next one. Okay, a common question too, will growing my business increase my profit? And that's not always the case. There's some growing pains as you go through different steps of business growth. And so there's some things that this is part of the reason why budgeting and forecasting is really important too, because it will help you to see where at certain step points you might run into some cash problems or even some profit problems. So there's some common challenges with growth include like your labor expenses are usually going to spike or will sometimes spike faster than your revenue. You might have increased COGS or expenses and it has some cash flow issues from that. And you might also have some operational issues that you need to deal with. So, adding 10 people to your team, it's going to be a heck of a lot harder than adding one person. So there might be a lot of onboarding and training and new systems and workflow that needs to be dealt with that are not really actually driving to your revenue out of the gate. There's a couple of different ways to grow. You can look at bootstrapping versus getting debt or investment. And then when to grow. At the end of the day, you want to grow when you've got the cash to support it, because at the end of the day, the old adage, cash is king. So if you don't have the cash to grow, then you can't. Okay, so you want to do that carefully when you've got the cash flow to support it. All right, and on to cash, common topic. Really quickly, there's some cash flow is a really common troublesome area for businesses as they grow. And there's a couple of levers that you can pull here that I've shared that will help you if you run into any cash tightness, okay, or cash issues. So first of all, you can increase your prices. You want to set those prices really well to start off with. If you haven't, you can fix that by changing your prices, but also you can increase your prices if you're having some cash flow issues. You can take a look again at what the market is charging and see if there's wiggle room in the market for that movement. You can increase your volume from a sales perspective, also from an expense perspective. If you're getting that volume up on the revenue side, you can generally get the volume discounts on the COGS side. You can reduce your COGS, so go back to your vendors and negotiate some better rates at those different volumes. A lot of times businesses will have a contract with their vendors, things will progress, the volume increases, they don't go back and negotiate again. So that's usually a good place to go. And they're usually willing to hold on to that relationship, and they usually expect a discount at a later date anyhow. So it's always worth going to them and seeing what you can do right away. You can also look at reducing your overhead. If you need to temporarily lay people off, it's obviously not a great thing to do, but it is something that can be a good quick fix depending on what's happening in the organization. Or looking at getting rid of your office or vehicles or whatever it is that is available there. Reduce your accounts receivable. So chasing your accounts receivable. We have a huge problem in BC with AR. In fact, the province of BC was actually looking at rolling out some additional legislation to help companies deal with this, because we have a problem with people paying late. So first rule of thumb, do what you can to not provide terms to your customers if possible. So payment on receipt. And if you do have accounts receivable, make sure you've got a good mechanism to chase those people right away. So if they don't pay on time, then you're calling them the next day, or somebody's calling them the next day to get the payment, have the credit card on file if you can, and you've got the right mechanisms in place so you can charge that card rather than having to chase them up, because it can create a lot of problems from your cash perspective. And then with your accounts payable, you can slow your accounts payable if you need to, just to give you a little bit of wiggle room, and reduce your inventory stock days. So you might want to reduce the inventory that you have on hand. So maybe not build quite as much, order as much to build to have on the shelves, slow that down so that you've got a little bit more capital in the bank rather than on the shelves. So a couple quick things to do to help with any cash flow tightness. Wait, there's more. If you want some more tips and tricks on cash and some other topics, we have on our website a business resources section that has some great blogs and some tools. We have a cash flow forecasting tool on there that you can download for free. They give you step-by-step walkthrough how to get a cash flow forecast in place. And our newsletter that has some tips and tricks on a regular basis. So check that out. And as well, as I mentioned before, we do have our discount out there for attendees today. So if you go to that link there, you can express your interest. So you don't have to pay now, just enter in your details. We'll reach out to you later about when we're going to offer that new course, that next course in July. That'll be all about how to set up your QuickBooks Online and how to do your bookkeeping. Okay, so head to the site. I think we'll have that link posted as well, so you can go check that out, and happy to answer any questions about that as we go too. All right, and we've got a couple minutes left, so I'm just going to blast through some quick applications, and if there's any questions, please do ask, and I'll try to answer them in the last couple minutes we've got left. Sorry, we're going a little bit quick here. We started a couple minutes late, and lots to talk about. So many tips, so many tips. Hopefully this is helpful for you. So one of them is Giraffe. This is one of my favorite planning tools. So this does your budgeting and forecasting really beautifully. And it does driver-based forecasting. So it can handle some pretty complicated stuff. So for those of you in the SaaS space, where you have some revenue deferrals or some really complicated drivers, this application is amazing. I love it to bits, and it's super visual, which makes it great. And it connects with your accounting software. So it pulls in your actuals and it updates it automatically, which is awesome. You're not manually doing things in Excel on a monthly basis and pulling your hair up. Another one is called Fathom. This is a reporting tool. It does beautiful KPIs. KPI tracking, so you can put in your KPIs for your organization, your targets, track those on a regular basis. It shows them in a nice little list view like this, and also in a visual view. You can see them grouped in different ways as well. So if you have visual people on your management team, this is a fabulous app to kind of get everyone focused and looking at the important things we need to focus on. It also has a break-even analysis in it, which is great. So once you're into revenue, then it'll show you how much revenue do we need to hit in order to manage our fixed expenses for the month. And you can see how this tracks over a period of time too, to see how your break-even shifts and adjusts if you have any seasonality within your business. So super handy. To actually build this out is a lot of work. This is a super easy, quick thing to do. In the app, it just does it automatically for you. And they also have a sensitivity analysis in here where you can actually play around with different levers and say, hey, okay, so going back to that slide on how to fix your cash. Okay, so if we were to say increase our price by 2%, then what impact would that have on the business? It'll give you a quick, fairly reliable, it's not 100% obviously because it's working off assumptions, it'll give you a very reliable impact of making some small changes. So especially if you have, say, a management team and people are really digging their heels in about not increasing prices, you can show them what that impact would be, and they might kind of have a better sense of how that might help the business. So it's got a great sensitivity analysis in there, and so this app is great, amazing value for the price point. The next is Veeam. So Veeam is a great app for sending cash and receiving cash. So if you're paying vendors, you can send them through Veeam. If you're on QuickBooks Online, those payments are free, which is awesome. And it also does cross-border and at a really awesome exchange rate. So I kind of liken it to the TransferWise, but for business. It's much more secure and it's meant for business. So Veeam's a great app there. Okay, so that's all I'm going to blast through for today. Thank you so much for having me here today. I hope this was helpful. Here's my contact details again. Do we have any burning questions before we close up today?
Yeah, thank you so much, Helena, for that amazing presentation. And I was really enjoying some of the food references you're talking about, like the recipes for success. And I was thinking to myself, man, I think I'm getting hungry. But
Hopefully
add in
not
a
for lettuce ice cream, right? No
not
lettuce
for
ice
lettuce
cream.
ice cream, but we got to get a dash of hustle, let it bake a little bit. At this point, yes, any of the participants or attendees, please write your questions. Haven't noticed any questions yet, but if you do, please, we'll take a few just moments just for people to type any questions. Actually, I do have a few questions. I think
Sure.
we can just throw out there to see how it is. One of the things I've noticed, especially when I'm talking with some startup founders, it's as they're starting to scale. It comes the age-old question of when do I start building my in-house team and when do I
Mhm.
rely on outsourcing? I'm curious to kind of see your perspectives on those and how it's playing out.
Whew, that's a really good question because I've seen people burned on both sides of the fence.
Exactly.
At the end of the day, it's you got to get the right people.
Hmm.
And I can't stress enough, like you having a startup, you need really solid people on your team that are probably going to be more costly than you have cash for. Unfortunately, not all people work well in a startup environment. Okay. If you think of it, like a lot of people are working from home right now.
Hmm.
Not all people work well remotely. Like, you know who you are, you people up
Yeah.
there. But, it's the same kind of thing. Not all people can hack startup life. Okay. It's sexy and it's exciting, but it's also super chaotic. And no matter how much you plan, sorry, truth's out. And you need people who are able to be totally enrolled in big, crazy ideas. Okay.
Hmm.
And rather than being scared of them, go, okay, cool. I got 17 ways that we can deal with this. Let's go. And that's a different kind of mindset than the average person who is going to probably come at it from constraint and go, oh, that's not reasonable. And when I worked over here, like that was never possible. And no. So whether they're contractors or employees, I don't know. As long as they've got the right mindset and you can afford them, and they're actually helping to move the business forward at the pace that you want to move forward, it doesn't matter. And then when you get to that point, like if you go contractor first, there'll be a
Hmm.
point where naturally you're spending enough to hire an in-house person, and you'll kind of know that naturally. But it also depends on where you're at from a team perspective. If you don't have people to manage people internally, then don't bother, because you have to factor in, once you are bringing people in internally, you have to spend like at least 25% of your time just kind of babysitting a little bit. And over, don't, I hope my employees aren't watching this. But supporting, mentoring them, all those nice
Of
HR things.
course. Yes.
But you have to handhold them and support them and everything, right?
Hmm.
In a different kind of way than you do with a contractor who owns a business and is an
Hmm.
entrepreneur and kind of gets it in a different kind of way. So I
Hmm.
don't know if that answers your question, but I think I would say just get the right talent, whatever that talent
Hmm.
is, because it can make or break your business. Quite frankly,
Hmm.
I've seen businesses that have really been challenged because their beginning hires were just
Hmm.
not experienced enough for what they needed, or were not enrolled in what they were trying to do. And
Hmm.
especially if you're a tech company and you've got developers who are not enrolled in the
Right.
bigness and the pace, you're going to have major problems.
Hmm. Yeah, thank you for that. I think it was really great. We touched upon all these points, and one of the big things, we talk about it's the balance between trying to get the kind of the low cost hires, outsourcing,
Yeah.
versus longevity, trying to invest into your future employees and to build up the team where people can do quality work. And I think kind of along the lines of that, I'm curious on this one. It's having worked with so many different companies and
Mm.
different groups. It's have you kind of seen a theme of people coming to you for specific types of helps, or maybe they said, hey, check out my business. Is there anything wrong? And you say, oh, here it is again. The same common problems that are
Uh,
coming up.
well, I mean, I talked about 7 of them, but like
Hmm.
the no, like
Hmm.
no effort or money put into account and into finance.
Right.
Um, and it's just when you're going outside to get some help, that's the first thing they want to look at. I'm not saying this because I'm biased, but they really want to see,
Hmm.
like, okay, do you have a good idea, and let's look at the financials. So not getting your books up to date, it just doesn't cut it anymore. Like we're kind of past that day where you basically take your stuff over to your tax accountant, they do your tax return at the end of the year, and then you've got your financials, and that's good for
Hmm.
a year. It's not good enough anymore. People want to see, like, well, how did you do last month? And if you can't produce that, then it's tricky. So getting your books in place and up and running and just doing it on a regular basis. And like I said, we've got that offer to show you how to kind of get that up and running cost effectively. So it's not doesn't have to be a big hurdle. And then if you're hiring somebody to help you with your accounting, make sure you hire a good person, because I've seen so many books come to us where it was just like really, really poor, cheap bookkeeping. And you end up spending like 3 times the amount fixing it than the cost saving that you get at the start. And then I guess the other thing is, waiting too long to get help too. So some people wait till it's like almost like they're almost out of money before they're like, help. So, having that forecasting in place.
Right.
And I actually pick up the phone and people are just yelling help at me. No, I'm joking.
I can imagine that happening.
But, like having that forecasting in place, even if it's something rudimentary and basic, like back of the envelope, just something so that when you're going to run out of cash, so that you can get that help sooner than later. Because when you get to the 11th hour, nobody wants to lend you money when you're at the 11th hour. They're happy to lend you money when they can see something positive in the future. But when they see like you're out of money next month, it's really hard to get people on side and enroll people. So, just get the help sooner than later and have a good plan. And then you can get people excited about what you're doing.
Yeah, that's awesome. Thank you so much for that. I'm just looking at the chats. It doesn't seem like there's any other questions coming in. Going once, going twice. We have a Connor Powell who messaged thank you with a happy face. So you're getting some engagements. And yes, Jose has been putting up your links on there, so
Cool, thanks,
attendees can click on them. I would say maybe I have one last question, kind of just to shoot at you, which is when people or groups will be engaging with you or with Entreflow, what can they expect?
Yeah, so we have a big team. I didn't really mention this actually. We've got a really awesome team of over 20 consultants. So lots of nerdy accountants, but we're cool, we're fun, and HR professionals. And so we do an onboarding process with our clients first of all. So if we're going to take on your bookkeeping, we do a monthly package of bookkeeping, controllership, and fractional CFO. So really known for fractional CFO work. And we work with a lot of startups to help them, really get out there. And so we'll do an onboarding process first, just to make sure the books are all up to date, this right technology is in place, automate as much as possible, get to know each other, get that budget and forecast set. And then from there, go on to the, your monthly maintenance mode, as we call it, where we're really looking at closing your books on a monthly basis, analyzing what's happening in the business. So looking at your KPIs, analyzing your budget, getting your forecast in place, talking strategy, figuring out what needs to be worked on, and guiding you through that on a month-to-month basis, and helping you along the way to wherever that might be. So it might be in HR, it might be in marketing, it might be, connecting you with anybody that we need to get you connected with to get set up for success. So kind of piecing out things month to month so that you're on the right track.
Yeah, thank you so much for that. Yeah, I'll definitely drop you a message. I have a number of clients that are looking kind of for that kind of back end support, the bookkeeping support, and the expertise that comes with knowing what it is to work in a startup role. So yeah, I'll definitely pin you a message. And I think that's it. I didn't see any other questions. Helina, was there anything else you wanted to end off on before I close the session?
Thanks Emil for having me. I'm delighted to be here. It's been a couple years since I've been here with you guys, so it's exciting. And for all of you out there who are growing a business, like, well done. It's not easy. I totally get it. So just be kind to yourself, and keep working at it. It is so worth it. And get help. There's lots of people out there to support you, so you don't have to do it yourself, and you don't have to reinvent the wheel all the time. There's a lot of people out there that are able to support. And feel free to reach out. My contact details are there. Happy to answer any questions, any crazy ideas, what have you. I get them all the time. So happy to support, and thank you to everyone.